All right. Hello, everyone. Thanks for responding to our June public community events. Our event is titled Tariff Turbulence. Um, oof, because initially we are going to call it Trump's Impact Insurance, but I was muted. It's called This is 228. So anyway, that's our new title, Tariff Turbulence. And I shared this with some of you. Initially, it was we had another event it was supposed to be this, which is going to be claims in motion. That was our original title of this event. And we had it open for like a month, and then like two people register, and they're like two of our friends. So I don't know, there's just not much interest in claims, so we changed to this, and then all of a sudden here you are. So glad you are all here. I'll just share a little bit intro about us and some of the things we do, and then I had passed it over to the panel. We'll talk about the tariff impact insurance. But for those of you who don't know us, we're InsurTech New York. I'm Tony, one of my co-founders, and we run different programs to connect different players. You see here, tech enablers, InsurTech brokers, carriers, and brokers, investors, associations, and other advisory firms through different programs we have. And we run 3 different startup programs. So we have our early stage startup competition. We have InsurTech Match and MGA Lab, which I'm going to talk a little bit more about. We also host a lot of education networking events, which this is one of them. We also host a bigger annual spring conference called InsurTech Spring Conference. Is next year is going to be March 30th and 31st in Pier 60. And so hopefully you can block that off and come to our event. I know there's InsurTech Insights happening the next 2 days. And hopefully I'll see some of you guys there too. And then we also have a venture fund. So we invest in startups, and some of the attendees here are our portfolio companies. And we try to help them connect. That's kind of what we. This is our calendar for the next basically 12 months. You see here, beat up claims. So we forgot to change that. That was the original title. Now it's tariff event. And we also have a couple webinars coming up. There's Agentic AI webinar and the No Code, Low Code webinar in October. And we also, a lot of different events that you see. I'm not going to go through all of them, but Spring Conference, March 30th, 31st is definitely a big one. So hopefully you can come back to New York if you're not from New York, but if you're in New York, just come to us. And I'll share a little bit more about 2 other things you see here, InsurTech Match and MJ Lab. I think when I saw the attendee list, there were a lot of startups. So hopefully some of you guys will join us in our program. So first program I want to introduce to all of you is called MGA Lab. And we are hosting a virtual information session. You can just register and join us. Who should join? If you're an existing MGA trying to add a new line of product, or you're a non-US based MGA from Europe who wants to create a new MGA business in North America, or you're a broker trying to add a new MGA product, or a data startup wanting to create a new MGA product using your data. You guys are a perfect fit for us. And why you should join is we're going to provide you the playbook and learn everything you need to know to create an MGA business in North America. And I will connect you to mentors who've done it, created MGAs themselves, or from carrier perspective, underwriters, actuaries, and legal mentors. Actually, many of you are here. And then finally, after going to the program, we're going to connect you to carriers who can give you capacity and fronting license. And also, you'll get to meet distributors who can distribute your products too. So basically, everything you need to know, and in terms of content and also people and companies to create a UFG business. Key details, we do ask for a little bit of equity, 100K in equity based on latest valuation. The program starts August and November. Most of the program is virtual, but we do have 3 in-person days in New York. And bonus is if you're a part of MGA Lab, you get InsurTech Match basically for free, which I'm going to talk about. And you're automatically enrolled in InsurTech Match. So that's MGA Lab. And the next program is InsurTech Match program. We have an information session for this a week after June 10th, June 17th. And this is a bit broader, so it's not just MGAs, it could be anyone, but they do typically want the companies to be a little later stage, 250K in AR or more, had multiple customers, financing stage could be C to Series B, and types of business can be really any InsurTech, could be MGA marketplace, B2B SaaS or data provider, any lines of business. And I didn't kind of talk about this, but this program is paid for by our carrier broker partners who are, basically, we are running a program for them so they can meet InsurTechs they want to work. So it's very specific to what their needs are. And so because of that, we can help the accelerate partnership with these carrier brokers because they are sophisticated asking us to find companies like you. And beyond the opportunities for carriers and brokers, you get to meet other founders and mentors. And we also have an investor demo day where you get to catch in front of 50 plus investors, real investors who actually invested in insurance. This program is zero cost for startups because, again, it's paid for by carriers and brokers, and you are guaranteed to meet them because you will not be accepted if they didn't want to meet you. And it's just one required in-person day in New York in September. And there are other optional days, 2 optional days in New York and 2 virtual mentor days. So it's very low effort, high value. If you want to learn more about the information, I got loud all of a sudden. Okay. If you go to our website, InsurTechNY.com, and go to for startups, first you can go to MG Lab and sign up for the information session or apply directly, or you can go to InsurTech Match program and do the same. All right. So with that, we're going to get started. The speakers can come up. So I'm going to pass it on to David. I was going to moderate this panel. This is a great panel. I think they're all economists, right? Am I right? Which is kind of amazing to how all of you guys here, and then they'll go into detail of how tariff is impacting insurance. So David, take it away.
Thanks, Tony. So for those who don't know me, I'm Tony's business partner with InsurTechNY. And, he was very humble to say that we were originally going to do this about claims. But I think the story behind the story is, I was just looking at all the events that were happening and, had been going to a bunch over the past few months. And I just kept asking myself, the only thing on the news is about tariffs and interest rates. But you look at these agendas and nothing's there. So I felt like there was a missing component. And since we do events, we're probably the ones to do it. So now we're up here and, hopefully with these 4 economists, which were very difficult to source, we're going to have an interesting discussion. So, just quickly, so you have the context, right? So Rodrigo runs an InsurTech, which they actually do climate-focused insurance. And he has, a deep understanding of what's happening, not just in the U.S., but in South America because of their lines of cover. And a lot of South American countries have, tariffs and control. So he has some familiarity. He's a Harvard-trained economist. And then Peilin is going to provide the life insurance side. So she's at AAA Life. We met when she was at Western and Southern, has analytics background, also is an economist. And then Matan is from Armadillo, which is a home warranty startup. He said even though he was an economics major in school, he's going to be talking about the real world effects because they actually are in the trenches with home warranty. And then last but certainly not least, Kevin, I realized that we're sitting in a university right now at St. John, and he's an NYU professor. So you have to have someone that's going to do the lecture component. So he told me all the difficult questions I can give to him to kind of reward him for the difficult questions that he asked for the students. And then he's also the CIO of a family office as well. So you have a broad perspectives, and I have a bunch of questions, but, we're going to allow your curiosity. So, I mean, towards the last kind of bit, if you have questions, like, we'll definitely leave it open to the audience. So, I think, Rodrigo, since you have the broadest perspective, we'll start with you. And, when you think about tariffs as, logically speaking, like tariffs are about physical products that are shipped from one nation to another. Insurance is not a physical product, right? It's like almost the antithesis of it. It's literally a paper contract of a promise that hopefully is real that the company will be able to meet in the future. So, given some of the areas that insurance impacts, right? Whether it's construction or surety or credit, where are some of the areas that are directly impacted and maybe indirectly impacted by tariffs?
Yeah, sure. Well, can you hear me? Yep. Well, first of all, thank you for there you go. Thank you for the invitation. Yeah, I'm gonna do the supply and demand. I'm gonna use the supply and demand framework for answering this question. It's true. Like, tariffs are mostly for the physical good, but there's a connection with the services. That's something that we all do. And a large part of okay, switch. Is it worse? Oh. Okay, I can speak loud.
Or just take Peilin.
Okay. We share.
You can trade.
Sure. Okay. Yeah, there you go. Yeah. So there's a connection between the physical world and the services, right? And tariffs are like a big supply shock. That's the thing, right? Like, there's an increasing price in everything. And that everything for insurance means that, for instance, car insurance is, the parts are imported. Most of the parts are imported from Mexico and Canada. So that means that car insurance is expected to grow 19% this year. That's a lot, right? The other one, which Matan is going to tell us about, is property and casualty, right? The cost of repairing a house has increased substantially, right? Between 5 and 60%. And this is like in the national news. The other piece is trade, right? Business interruption. So there are cargo ships that are being halted. That will have an impact on. So these are all raising the costs for insurance companies, right? The other piece is reinsurance. If interest rates go up, then there's more competition for insurance products. That means that reinsurance prices will also go up, right? So this is very, very on the supply side. Now, like the demand side is what's going on with the economy, right? And we are experiencing record high levels of uncertainty, right? This is something that we haven't experiencing in a long time. And the basic business, it's skill. Not up to the reason. Maybe it's like I'm talking too much. I'm gonna try to wrap it. The second piece is that it's becoming so uncertain, right? And this has a direct implication because insurance companies, they make money out of two things. One is like reducing the cost of claims, and we're seeing that those costs are going up. And the other one is investing wisely the money that they collect, right? And they typically invest on bonds. 60% of the investments are on bonds, like government bonds and corporate bonds. The problem there is that as interest rates go up, the problem is that if you had bonds 3 months ago and now the interest rates are often are higher, then the bonds that you have are priced lower. That means that insurance companies are losing money, right? So that's creating another pressure. So it's becoming a perfect storm. And the final piece is that we are potentially in the verge of a recession, right? And that can go both ways. Oh my God, that's it. Yeah.
So really, to capture it, really, there's three components you're saying. On the supply side, input prices for things when you're repairing something becomes more expensive. So ultimately, severity increases. And then on the demand side, there's uncertainty, which could be good or bad, right? People may buy more insurance when they're uncertain, or they might have less, additional money that they can use to buy insurance. And then overall, insurance companies on the asset side have to figure out how to dynamically adjust their portfolios when bond prices are ultimately decreasing when yield goes up, which we'll dig into more of many of these topics, but I think that's a pretty solid overview. And so let's consider that all first order, right? So supply, demand, and, asset values. Kevin, since you're the professor, we got to get into the second order consequences, some of the more complex things that maybe don't quite make it to CNN, but they're really on like Bloomberg. So one of the things that I've heard on Bloomberg is that because of tariffs, countries are responding and saying, well, if you're going to tariff us, we want to have some kind of economic response. And the kind of quote unquote nuclear option of economic response has been the idea of dumping U.S. treasuries, because ultimately, if the political landscape leverage is the ability to have the staying power to keep these tariffs in place, if every time the bonds go up, Trump does the taco trade where he basically gives up on everything, then, they don't have much staying power. So the question is, based off of your perspective, do you think it's a real chance that this nuclear option could happen where essentially countries are going to dump their U.S. treasuries as a retaliatory response?
Sure. First, really appreciate the invitation. Know you guys for some years now. InsurTechNY is very, very good organization. Happy to be here. And then I guess about this question, I guess for a tariff, in fact, I think this year, I was end of last year, a lot of people were expecting the tariff to happen. But I think the market reaction has been very different. I would say pretty much opposite to what people were expecting. Number one is dollar, right? Most of people last year were expecting when tariff go up, dollar should appreciate, because the logic is very clear that, you increase tariff, you'll be less export, also less import, more export, dollar will go out less. There will be dollar appreciation. In fact, what happened was massive dollar depreciation. And of course, I guess relate to the secondary effect, which is you got, we mentioned about the carry trade, right? The Japan investor, life insurance company from Taiwan, they lost a lot of money because, when the bond market reacted negatively, which is really opposite what people were expecting, because you were expecting, when the tariff goes up, a bond should go up because there will be a bit more fiscal income, which the market reacted totally differently. And I think which brings essentially, not only the stock market, bond market, and also the currency market to go down together in April, which is very, very, I would say, abnormal in a lot of ways. We had some economists who are saying that the U.S. economy is acting more like emerging market, basically. When you have a crisis, emerging markets economy tend to have bond and stocks go down. When you have developing economy, you tend to have a bond and stock market to have a negative correlation. Bonds should go up, stocks should go down. And I think made a lot of people to be very, very puzzled. And but on the other hand, I guess the whole tariff part of it is a global imbalance. Related to what you mentioned about the bond, the foreign purchase of the U.S. Treasury bond, in fact, peaked in 2007. If you look at statistics since 2007 to now, every year foreign purchase of the U.S. bond has been declining. It peaked about roughly 55% foreign ownership. Now it's down to roughly 20% foreign ownership. So I think it's a big problem how to address this, how to make the U.S. government bond to be attractive to foreign investors. In particular, I guess, I think Rodrigo mentioned about insurance companies, right? Japanese insurance companies, European insurance companies. These foreign insurance companies are major buyer of U.S. bond, including treasuries. And now they're not buying. In fact, also, I would say Moody's downgrade U.S. Treasury rating, which in fact is hurting more. So I think we are really in some kind of uncharted territory with all the things happening opposite to what people would expect.
Yeah, so maybe to summarize a few of Kevin's key points is maybe it's not even necessary for the fact that people are going to take the nuclear option, because if you chart from 2007, when everyone was buying treasuries, it's kind of decreasing, and now it's more internal banks, insurance companies, pension funds within the U.S. and your own pension fund Social Security that's required to buy the treasuries. So when that happens, everyone thought dollar values would go up relative to other currencies because the US will be stronger, but in fact the opposite has been happening. So, all of that is interesting, of course, and there's a lot that reinsurers have to deal with, but probably for the purpose of our conversation, if we dig in too much, I think a lot of you will get lost. So let's transition to Matan and focus on real world applications, because I know you take 50% of the risk for your business. So from a practical standpoint, like people's appliances, when they fail, do you believe that the cost of the appliances are going to be more expensive next month, 6 months from now, and a year from now? And does that mean you need to charge more for your insurance, and that you want to force people to buy U.S. appliances?
Great question. And first of all, I want to say you were very generous with calling me an economist. You guys. So I'll break it down to what we do. We offer home warranties, which is similar to home insurance. Warranty is very similar to insurance. At the cost of insurance, we collect revenue and then we pay out claims. And we cover unknown future events, which are breakdowns in home systems and appliances. And that's why David mentioned appliance repairs. We, ever since COVID, we've been experiencing a rise in costs, home costs. So there's been inflation already, and we're operating under the assumption that inflation will continue to do this. We don't know what equilibrium will, with all the tariffs and what will happen and where those will end. So we just operate as if they're going to costs will continue to rise. We cover appliance replacements. We also cover repairs, which means that we work with technicians around the country, and those technicians will buy parts like a gasket or an ice maker for a refrigerator. Those parts are going off. And the way we think about it, because we operate in a highly competitive environment, which a lot of insurers do, especially in the non-commercial side of that, auto commercial, but homeowners are very competitive, auto very competitive. We can't just raise the rates without seeing lower conversion rates. But what we can do is we can change our terms and conditions, our policy language. We can raise rates, and we can negotiate with the commissions a different way. But we've come up with different methods that allow us to control inflation. I'll give you an example. Out of every 100 claims, and we get a lot of claims, our product has 1 claim per customer per year. So it's what we refer to as a high frequency product. So we have a big customer service department. They talk to a lot of people all the time. We get calls from homeowners, something breaks down. Out of every 10 claims, 3 people will say, I want to use my own technician. So they're not using a technician that we have negotiated rates with. They're using their own. And that's a feature of our product. It's an innovation of one of the things that we did in the market. But when you call your own technician, they're going to charge you refill rate. So that really is exposed to inflation. So we had to come up with something, and we created, it's kind of like a medical reimbursement policy with a very detailed table that says, if your refrigerator breaks, here are all the things that we will reimburse you for. You get a table. It's a detailed table, and that allows us to set rates at the part level. It's a tool that we could use to combat inflation without changing our rates, because we can adjust that table over time. We have a short tail product, so like life insurance, which we'll hear more about, is a long tail product. A lot of commercial insurance are long tail products. Our product is, we've earned the risk out very quickly. We can change our terms. We can change our rates without filing in all states, by the way, which is a perk of being in warranty. But we do things like that. It's how we have a lot of tools, a lot of levers without even raising the rates, even though raising rates is, we do rate at the appliance level. So I'm an actuary by trade. We do rate at the appliance level. We have a severity model, a frequency model, and that gets adjusted. But we don't do it as often as we could, because of it's a highly competitive market. So hopefully that.
Yeah. So it sounds like, Matan, basically your perspective on this is, because of the frequency, you're having every customer have a claim once a year. You have real-time data coming in, so you know how much each electrician or plumber is charging to work on the appliances, and you're going to kind of adjust it accordingly, but you're going to watch, what some of your competitors are doing and kind of mirror some of that so that you don't lose share along the way.
100%.
So, the first section of this, a lot of it was setting the stage and talking about some of the direct implications, which tend to be on the property and casualty side because it's most connected to the physical reality. And for the next section, it's probably worth talking about the life and annuity side, because I know a number of you are here on the life and annuity side, and you're thinking about how does this affect, my life? How does it affect my company to make sure, everything is okay? So maybe Peilin can kick us off. And, we talked a little bit earlier about this impact on bonds, right? And the big mile marker that we hit, which was, I think last week, the US 30-year Treasury was above 5%. And I think a month or two before that, the 20-year had like a quasi-failed auction there. That was above 5%. So if you're, a life insurer, you have this kind of job where you have assets and liabilities that you have to match. So what would you recommend to someone in, asset management at a life insurer? Does that mean they need to go to shorter duration, 6 months, 3 months, and wait out the storm? Do they need to, buy some type of hedging, or should they just find a reinsurer that's way smarter than them to figure it out for them?
I'm here to bring it back. So this is what I worry about. Since AAA Life is a direct-to-consumer life insurance company, what I really worry about is how the consumer would behave and react because of tariff, because of inflation, because you're going to see that immediately. Yes, I think David's question is extremely smart, and I was here because I'm the only female that is also an economist. So number one, but number two is we need to pay attention to the macroeconomics because it's impacting our business already. And there's such a long tail. And therefore, what do you do? How do you watch? Because are your results on the decline? And are you figuring out what that is? Because consumers are very sensitive toward these events. And we had a debate a little bit earlier with David. David thinks that when stuff like this happens, it could go either way. Either people buy more or they buy less. What I'm currently seeing is people are buying less because they are feeling the pressure and they're listening to the news and they don't know how long it's going to last. So that's a real problem. And that's the first part. So if I were a life insurance carrier, I would start pushing toward demand. Try to get more demand right now, today. Increase your media spend. Try to see how you can get more today. And then kind of look at your lapse, start tracking your lapse and start evaluating whether your price need to be adjusted with the actuarial involvement. So that's the second portion I will do. And the last portion, which is David's question, I'm going to skip because I will go straight to a reinsurer because that's a much easier way to manage the back-end business.
Yeah, no, I think this is one of the most complicated things. So the benefit of the reinsurers is they have the data, not just on your life insurer, but on 15 other ones. So they can aggregate that and they can manage the risk across, maybe US demand for life products is decreasing, but in Europe, everything is fine, if not better, because, so their central banks have already been cutting rates and, adjusting the economy. So, Kevin, I'll give you maybe another difficult one, but, one of the kind of oracles we have to come up with is, June 17th and 18th is the next FOMC meeting. And if you look at rates across the world, right, many European central banks have already cut. I think Australia's cut, Japan's cut. So what is your forecast? Are we going to cut, the Fed's overnight lending rate in the short run? And then does that affect how insurers should change their reserving strategy based off of, the dot plot going ahead? Sure. This is a very important question. I think earlier during opening remark, you mentioned about not finance market. Everyone is talking about tariff and interest rate. As of there are two different topics, but in the end, I think they're the same topic. Right now, in fact, I think why the Fed is not cutting the rate is because tariff. So, and then, even today, I was at a lunch, the Federal Reserve Governor talked about, we would like to wait and see. We like to see what the tariff will end up with and decide the interest rate. So, and on the other hand, inflation right now is coming down, but the expectation of inflation is higher now than before. So this is a very strange combination too. Usually when the inflation is going down, people should have lower expectation for inflation going forward too, right? But now inflation expectation is going up. And then unemployment rate, in fact, is going up. There are some rumor about the non-farm payroll would be very bad. Some horrible numbers are being circling around now. Usually the U.S. economy should generate roughly 250,000 jobs per month. Non-farm payroll, I've heard some more rumor talking about 80,000 coming out. So that will be very bad. But if you think about all those, the Fed has to cut the rate. Unemployment goes up and inflation is coming down. But they are not doing it because tariff. So I guess now comes the question, what's going to happen with tariff, right? Tariff right now, we have 90 days kind of on pause. And one way or the other, hopefully it will be resolved. But if it's not resolved, the uncertainty is there and the Fed will not cut the rate. And there's a big disconnect too, because Wall Street, in fact, has an expectation of 4 rate cuts this year. And so far we got 0. And I guess, if the Fed starts cut every time when they meet for the rest of this year, they would barely meet the Wall Street expectation. But I doubt it will be the case. So we are not going to get the cut that the Wall Street is expecting. And I think a lot of sectors are suffering right now. You see the loan, I think the default rate is going up. You saw delinquency and also for the housing construction application, it's all going down. So they need a rate cut, and the Fed is not doing it.
Yeah, I mean, Kevin, it sounds like that you're basically super pro-Trump on economics here. You're like, hey, Jerome, I need you to listen to me and we need to cut rates. But, I think all those data points are really valid. I heard the same rumors that job reports are going to be, sub 100,000. But what was interesting is, I don't know if you saw last Friday, the job openings were strong. They were over 7 million. So it's like, it's like a hot and cold world where, the data on one side says, there's a lot of job openings, but the predicted data, which we haven't got the ADP reports yet, is that, it's going to be a really rough jobs number. But the other factor we haven't even taken into consideration is all these people that have gotten laid off of the federal government. So, that's a whole nother lens on it. But, I'm glad to hear you're in the rate cut camp, because I certainly am, but it's probably not going to happen in June.
I totally agree. I forgot to mention that what you point out, that Europe has been cutting rate a lot. ECB already indicated that we cut for sure again. So other countries are cutting rate. So the U.S. is going to be a very special case, essentially, as a very high interest rate economy in the world, which is very unusual. That usually central banks coordinate with each other to cut, but not this time. Yeah.
Is it because we have different government now?
Yeah, but it's the politicians want rate cuts, the banks doesn't. So I want to cover one last topic before we switch to the optimistic ending, because I feel like there's a lot of depression that we had. You did something optimistic. So, Rodrigo, for life insurance, one thing that they've had to think about is,
not just their bond portfolio, but private credit, which is now this like, everyone wants to get into private credit. It's like, the sheep going to the slaughter, or maybe not. But my question for you is, if the federal government just had Moody's do the last, rate cut, so now it's AA, there's no AAA rating for the U.S., does that mean that the insurers need to adjust their private credit models for everything to be adjusted down, or should we still be optimistic on private credit?
Well, that's a very deep, good question. I don't know the answer. But I think that let me change the question a little bit. Is like, under what conditions would private insurance companies be under trouble, right? I think that's a different way of put it. And the U.S. does not run stress tests for insurance companies because they are the ones that do the safest investments, right? But the Europeans do. So I found a paper in which they did these stress tests for insurance companies, and the basic indicator is a credit default swap. Basically, that's when the company is underwater and they are renegotiating their debts, right? Probably that's too late, right? If you're seeing a company that is already engaging in credit default swaps, that's already too late. So then, what are the drivers of this CDS behavior, right? And they divide this into like firm-specific macroeconomic factors, right? And firm-specific, it will be not a surprise. Right? Companies that are the most distressed are the more over-leveraged, right? Or the operating costs are the highest. On the other hand, is like if they have assets, then they will be better off. But I think the most interesting part, and going back to your points, is this macroeconomic question, right? And there were two very important factors in this. Of course, it was a statistical analysis, historical, and whatever. One is inflation, and you're not used to this in the U.S., but in Latin America, we are. In some cases, if you're an insurance company and you define the prices in January, and you have to pay your expenses in December, and there's inflation, then you will not be able to cover the costs, right? So that can create. I'm pretty sure that's not going to be the case here in the U.S. I think inflation is pretty much contained. But I think the other piece is the important one, which is what we were discussing here. Probably we're in a structurally different world in which interest rates will be higher for the foreseeable future, and there's an elephant in the room behind that. It's like a government deficit, right? If you continue on this path, then in this question of R versus G, right? Like the interest rate versus the growth rate of the economy. And for the last 20 years, the growth of the economy has been higher than the interest rate. The question is what is going to happen in the future, right? Because that's the primary driver of how all financial institutions get their money, how they finance themselves. So the question is that one, right? Like there are some very optimistic views, like Nora Rubini, who says that because of AI and everything, the growth of the economy is going to continue to be higher than the interest rate, and there's no reason to be worried about. But there's other people that say that, by 2030, 2035, we're going to get into the inverse position. And there's like, I don't know, that can open like a very different scenarios.
Yeah. So, no, it sounds like, it's not clear what the answer to credit quality is. I mean, I'm sure there's really smart people at Moody's that have their opinion and made their decision, but a lot of this comes down to where you believe the industry, the company, or the country has a growth rate versus, ultimately the cost of debt. So last segment we're going to cover is some optimistic things. So hopefully we can end on that positive side. So Matan, one of the great opportunities I see in front of you is that you have the ability to align with the trend. So if the trend is, we need these tariffs so we can manufacture and buy more American, you're essentially paying for people to buy new appliances. So how do you factor that into your marketing and your business model to actually make it an advantage?
I think that's a really interesting question because it's almost a marketing question for us. It's funny because in July we're doing a big launch, a big press release unrelated to tariffs and the inflation around sustainability. Essentially, we've built into every one of our products. If you have our plan and you replace your appliance or your HVAC we will give you a higher coverage if you replace it with an environmentally friendly alternative. But there's a higher coverage built into every plan, not public yet. So I guess this is the first hypothesis. We've mulled over, without being political. I'm not saying we're Trump supporters or not. Without being political, we've mulled over the idea of saying maybe we give a higher coverage if someone replaces with a system that was mainly built and manufactured in the U.S. That puts us a little bit in the political realm, and it's a marketing question and a branding question. What do we want to go in that direction? But there are a lot of it's true that we can align with the trend, and that's attracted to a lot of people, and it's something that our competitors are not doing. And we think about it, and I think we're going to do something. We don't know what yet, but that I think this is a good way to end on a positive note. I'm not saying that this is the last question, but it's a very interesting one for us. We think about that a lot. I think we have an opportunity to make an impact on the environment because the homes actually make a lot of pollution, and there are environmentally friendly alternatives. So we really we want to do that. But yeah, jury's out on what we're going to do with.
I like that message. So every claims dollar you can pay, you have a choice to tell your policyholders to, buy wherever or buy American, but, it's a marketing opportunity however you see it. So last question is for you, Peilin. Rodrigo kind of hinted at this concept of higher for longer. He believes that, because of the debt, our long-term interest rates are going to be very high. Since part of your world is annuities, 2024 was like a record annuity year because, people could actually get rates above that like 4% rule, and people bought that. There's a lot of people retiring. So do you think higher for longer means you need to get your salespeople out selling annuities like, no tomorrow?
Yes, totally. There are things I cannot say, but we are definitely putting in a lot of agents and a lot of calls, try to sell annuity, and talking to different annuity companies, try to partner because you don't always have to buy. You can rent, you can partner. So get on it because it's a really good opportunity. I'm pointing to an annuity carrier.
Great. Well, that wraps it up for us. I think Tony will close us out, but we're a little over on time. But hopefully the panelists will stay around and answer any of your tariff, economics, or inflation questions.
Labor economics.
Awesome. Thank you for the panel. I appreciate it. Let's give our round of applause.